Welcome back to EDS, and in this video I'm going to show you how to rapidly grow your trading accounts this year. This will work if you have a large account, small account, it doesn't matter, the mechanics are the same and that's what's important. So the first thing that you want to do is put up your brokerage platform, and we are going to be writing options contracts, which is what we always do here at EDS. But the thing that's going to be different is that instead of using equities, we're going to use futures. And the reason why we're going to write contracts on futures as opposed to equities is because futures allows us to use span margin, which is what allows us to be very capital efficient. So for example, we have SPY here. This is an equity. So let me show you the futures equivalent, which would be ES or /ES to be exact. And as you can see, it's basically the same thing, but in futures land. And a lot of times, equities have a futures equivalent, not always. And sometimes there's things that you can trade in futures that you can't really do with equities. So let's go straight into looking at some futures. So what you want to do is open up a futures watch list that has options available to trade on them. Your broker should natively provide something like this. If they don't, then just copy these ticker symbols and make your own custom watch list. As you can see, we've got everything from currencies, natural gas, corn, soybeans, cattle, bonds, all kinds of stuff, copper. So what you want to do is you want to get IV rank as one of your metrics on your watch list, and you want to order your watch list from high to low IV rank. And the reason why is because when we are writing options contracts, that means that we are short the contracts. And whenever you're short something, you want to sell high and buy low. And volatility plays a role in option prices. And volatility or Vega is high, option prices are high. And because we're short, we want to sell high and buy low. So we want to sell when volatility is high and buy back after the volatility contraction. And volatility contracts almost always in the market, about 80% of the time, and also volatility is mean reverting. So those are just a few small reasons why this strategy works so well, but we're going to go into even more in just a second. So once you've got your watch list set up like this, you only really want to be looking at things that have an IV rank of at least 30. So our cutoff point on this specific watch list today is going to be at the British pound futures, which has an IV rank of 30.9. We don't want to look at anything below this. Now, when it comes to picking an underlying, you need to keep in mind that futures are very big products. For equities, the contract multiplier is 100, but for futures, it varies per underlying. It can be in the hundreds of thousands. So just keep that in mind. But also, because span margin is used for futures, your volatility or your IV is taken into account. So one factor that plays a role in how much buying power that's going to be required to open a position on futures is how much or how high is IV. And the higher the IV, the more buying power that will be required. So as a general rule of thumb, if you have a smaller account, you want to stick to things like bonds, currencies, maybe some cattle, soybean, things like that, because those underlyings generally have smaller IVs compared to other things like natural gas, for example. So with that in mind, if you have a smaller account, just stick to those things. The Canadian dollar is really good for small accounts. I've used it so many times to grow small accounts. If you have a larger account, then by all means just pick whatever you like. Whatever you do pick needs to fit well in your portfolio. So if you're very heavy in any one sector or underlying, try to be a bit more diverse. The good thing about futures is there is a wide range of things, and if you were to sell a contract on every single one of these tickers here, or sell or write some contracts on every single one of these tickers, your portfolio would be in pretty good shape, assuming obviously the IV rank is over 30. So without further ado, I did mention the Canadian dollar. And as you can see here, it has an IV rank of 95.1. Just coincidentally, it happens to be at the top of the list. So we'll take a look at the Canadian dollar. I usually like to be in and around the mid to high range, but as soon as we mention the Canadian dollar, it'll be a good opportunity to show you exactly how much buying power will be required if you do have a smaller account. So once we've got that selected, you want to go over to where you can see a list of expiration dates, specifically option expiration dates for the underlying, because remember, futures contracts also have expiration dates. And you can see that here. So February 7th, March 7th, option expiration dates line up with the 6CH5 futures contracts, and then it rolls to the M5 contracts thereafter, and then the U5 contracts. But you don't really need to worry too much about which futures contract it is that you want to trade. We want to focus on the option expiration dates themselves, and your broker will automatically line these up for you. So the one that we want to pick needs to be between 30 and 60 days out in time, and there's one here at 57 days, April 4th, which lines up with the M5 contract. So that's the one we're going to go with, and we're just going to open that up. And now we are presented with the options chain for the April 4th expiration date on the 6C M5 futures contract. So very quickly, we have calls on the left, puts on the right. We have this horizontal orange line that shows us where the price of the underlying is with respect to the strikes that are going down the middle here. We have our IV in the top right, and we also have our expected move in parentheses, which is currently 0.02, plus or minus 0.02, and that's also visually represented by this vertical orange bar, and we have these dotted blue lines that show us our standard deviation levels. So when we are writing options contracts, that effectively means that we want price to stay away from those contracts. We want those contracts to be out of the money. And so how do we use this information to create a high probability of success for ourselves? Well, it's really simple. We simply just want to write contracts that will sit outside of the expected move. Now, the trick is to go outside the expected move, but not too far, because the further out you go, the higher your probability of success will be. However, the less premium you will collect up front, and therefore the lower your return on capital will be. So for me, I like to be around the 1 standard deviation level, and that will typically line up with a 15 to 20 delta on either side. So let's just start off with the call side. We have a 15 delta here at the 0.72 strike, and we have a 16 delta on the put side at the 0.68 strike. And as you can see, we've effectively created a range for ourselves by selling these two contracts, and both contracts are up against the 1 standard deviation level. They're between 15 and 20 deltas, and they are outside of the expected move, and that's going to give us a high probability of success. Now we want price to be within this range at expiration, which will be in 57 days time. Now how can we, or what is our probability of that happening? Well, if we look in the bottom left corner, we have our pop at 71%. Pop is probability of profit. Okay, so that means that we have a 71% chance of making at least 1 penny on this trade at the point of expiration. So already we have a very, very high probability of success. Anything over 50 is considered a high probability trade. Now, what if we don't want to wait all the way till expiration? What if we want to get out at, say, 50% of max profit? Well, we have this P50 number here, which isn't displayed for futures, but it's typically 10 to 15% higher than your pop. So our P50 would be around 80 to 85%. So we're looking at probabilities of success of between 70 and 85% straight away. So very, very high. And if we want to take profit at even less of a target, say 25%, we'd probably be looking at between 90 and 95% chance of success. So very, very, very high probabilities here. So how much money can we make? Well, assuming if we were to get filled at this mid price here, 0.0032, you'd multiply this out by the contract multiplier, which for Canadian dollar I believe is 100,000. We would get this max profit number here, $320. So this is how much we would collect up front, $320 as soon as this order gets filled. Now, our broker is going to require just under $2,000 in buying power to open this position. Now, I haven't looked at the Canadian dollar before this video. This is all live, and $2,000 is quite a lot more than what is usually required, but I'm going to show you how we can reduce that even further. But if you were just to go down the list, you'll notice that quite a lot of the currencies will be in and around the $500 to $1,000 mark for a naked position like this. But we're going to stick with the Canadian dollar because $2,000 still isn't too much. So we'd collect $320, and our buying power requirement would be just under 2,000. So how can we get a higher return on capital? We've got very, very high probabilities of success. So how can we get a higher return on capital? Now we can just be more aggressive with our deltas, with our contracts, okay? And anytime you are more aggressive, what will happen is that you will get a higher return, but you will give up some a couple of percent in terms of your probability of success. So you can't get one without giving the other. It has to be a balance. So let's say if we were to go to the 23 delta on the call side and we go to the 21 delta on the put side, as you can see, we're still on the edges of the expected move, but now we will collect just under $500. Our buying power requirement has increased a little bit, but not as much as our premium, so our return has increased. Now what if we be even more aggressive? So in a situation like this, IV is quite high for the Canadian dollar. Let's say if you wanted to go close to the 30 delta, we've got 33 delta on one side and 27 delta on the other. We're now going to collect $740 in premium up front, and our buying power requirement is going to be 2.5, just under 2.5. So as you can see, our return is getting higher and higher. But if you noticed, our pop has been getting lower and lower. So this is all just about finding a balance for you. Now, if you wanted to have a really high probability of success, and you wanted to get a very low amount of buying power required, what you could do is just go all the way out. Say if you go to the 6 delta. This isn't typically what I do, but as you can see here now, our buying power requirement has dropped all the way to just $333. Okay, we would still collect $110 upfront in premium, and our buying power requirement is only $333. So we're getting a very high return here. And if we look at our pop is 86%. So our P50 would be around 95%, maybe a little bit higher. So this is how you can use options and futures together to create very high probabilities of success, get very high returns on your capital. And keep in mind, guys, this is just in a 57-day time period. And if you wanted to get out at, say, P50, more often than not, you'll be able to get out around, with 57 days left on the contract, you'll be able to get out around 28, 29, maybe 30 days. So this is how you do it. And it's very simple. You do need to keep your buying power requirements in check, and I'm going to show you how to do that now. So we've created a free position sizing template that's available for everyone to use. The link is in the description. Just click this button and it will take you over to this spreadsheet. And the way it works is you enter in the size of your portfolio. So say if you have a $25,000 account, and then you can enter in the VIX level below. Say if it's 12.5. And then everything will then be automatically calculated for you. All you need to do is just use this information to form the backbone of your portfolio, and you'll be absolutely fine over the long run. If you would like to learn in more detail about what we do and how we do it, just click this button here, EDS Premium. Again, the link will be in the description. And get yourself signed up. Inside you will have access to our portfolio that allows you to see the positions that we're placing, how we manage risk, how we make adjustments. There is a full course inside, so no prior knowledge is required, and we will also teach you everything that you need to know from start to finish in the course. It's a private community, so if you do get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee, so once you have studied the course, followed some of our trades, if after 6 months you're not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free, and it's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life, no matter how high the price goes thereafter. So you are rewarded for getting in early, and the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us or reliant on us. We want to teach you the skill, and once you've learned it, it's something that you can take with you for the rest of your life. No one can ever take it away from you, and it's a very, very powerful thing to have. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You are always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.